Everyone, I will pass it over to Alison, our moderator for this panel on Hong Kong and its role in terms of Chinese capital formation. Everyone in the audience, you will be on a listen-only mode, but there is a Q&A function at the bottom of your screen, which you'll be able to utilize, and Alison will do her level best to get to question through the course of the next 55 minutes. So, Alison, I'm going to pass it over to you.
Sure, that sounds great. Hi, everyone. I'm Alison Schoenberg, and I'm a Business Advisory Services Manager at the U.S.-China Business Council. We're in for a really interesting discussion today on Hong Kong's role in China's capital formation and broader trends in Hong Kong and mainland Chinese capital markets. We're here to challenge, or at the very least, critically examine the narrative that Hong Kong is losing its appeal as a financial center. For all of the recent political changes that have transpired in or targeted Hong Kong, the National Security Law, the Hong Kong Autonomy Act, and other US government efforts to eliminate special treatment for Hong Kong, it remains strategically significant and connected to mainland Chinese companies and capital markets, and continues to attract new listings. Our speakers today will talk about how these trends are likely to play out in the near future, and will provide additional insight on the significance of Hong Kong's financial markets to mainland China, recent trends in the Hong Kong exchange, the increasing importance of Hong Kong as a source of equity capital for mainland Chinese companies, particularly tech firms, and any potential impact from the national security law and US efforts to delist Chinese companies from US stock exchanges. We have the pleasure of hearing from 3 speakers today on these topics: John Malloy, Andy Rothman, and Becky Liu. John Malloy is the Portfolio Manager of Emerging Markets Strategy at RWC Partners. He also serves as a member of the investment committee for the RWC Emerging and Frontier Markets Strategies. Andy Rothman is an investment strategist at Matthews Asia. He's primarily responsible for developing research focused on China's ongoing economic and political developments, while also complementing the broader investment team with in-depth analysis on Asia. And Becky Liu is currently the head of China Macro Strategy for Standard Chartered and is based in Hong Kong. Her main coverage areas include China's onshore and offshore FX and fixed income markets, and the Hong Kong rates market. If you have any questions, as Paul mentioned, during or after the presentation, you can send me a message directly on Zoom using the Q&A function, either privately or to the group as a whole. I'll now pass it off to John for his introductory remarks.
Great, thank you, Alison. Good morning, good evening, good afternoon, wherever you are all over the world. I know Becky's probably up later tonight. In terms of RWC, just a couple minutes on our business. We manage about $9 billion. We have a team, I'm in Miami, but we have a team all in Singapore, in London, 20 people. Obviously, a big part of that 9 billion, about 40% is in China. So very important to us and very much focused on what's going on in Hong Kong. We focus on growth, we focus on macro thematic, so that's really key. I would say it's interesting to note that the environment we're in, especially the political environment in the US and the political environment that we're in Hong Kong, one would think that the Hong Kong market and what's going on in the capital markets there would be under a lot of pressure. And that couldn't be further from the truth, frankly. I mean, at this point, you have many companies looking to dual list. So basically, move from the ADR market into the Hong Kong market. They are viewing this as a risk mitigator, and then also investors like ourselves view it as a risk mitigator as well if the US government were to do something. And so, with that move, the market has been very, very strong. It's interesting too that international investors have definitely welcomed that move. We had a conference yesterday for RWC, about 200 of our investors. We polled them, what's the demand for a dedicated China fund? 80% of the participants said that they are interested in a dedicated China fund. And then also, what's their view on the geopolitical risk of US-China beyond the election? And 80% of them thought that that would continue. So tensions beyond, so this is not a short-term phenomenon. But what that says is that despite that risk, that investors are looking through that, and investors believe that China will be able to hold their own in this confrontation that we're seeing between the US and China. And so with that, as I mentioned, the markets are very strong. The MSC China index is up about 17% year to date, and our China fund's up 31% year to date. So that doesn't sound like a bear market to me. So Over to you, Andy.
Thanks, John. Let me start with just a couple of words of background about Matthews Asia, where I've been working for the last 6 years since moving back from China. Our company was founded in 1991. We're the largest Asia investment specialist in the US with about 24 billion in assets under management, 43-member investment team with offices in San Francisco, Shanghai, Hong Kong, Singapore, and London. We work with institutions, including family offices, as well as advisors and individuals globally. And our focus as well is primarily on China. I want to briefly touch a few topics before we get into the headline issue of the political relationship in Hong Kong to the investment environment there. I think we have to talk about COVID first, because that's the most important issue in every country today, including for the investment environment. And in China, it's basically under control. There's been more than 30 consecutive days without a single locally transmitted COVID-19 case in China. Less than 150 patients in hospital, which is down from over 600 a month ago, and 58,000 in hospital at the February peak. No deaths in China due to COVID since April 14th. Since the pandemic began in China, which is home to about 18% of the world's population, they've recorded 0.5% of the COVID deaths. In the US, in contrast, which has about 4% of the world's population, we've had 21% of the world's COVID deaths. Now, some of the methods China used to control the virus wouldn't work in a democracy, but many aspects of their approach have worked in places like Taiwan, South Korea, and Canada. The second topic I want to touch on briefly is that with COVID under control, the Chinese economy is bouncing back. Life in China has been gradually getting back to normal since March, and August was the 6th consecutive month of a V-shaped economic recovery. And China's economy is increasingly driven by domestic demand, so it's important that consumer spending has been bouncing back. We've seen traffic jams and long lines outside of popular restaurants again. Auto sales have posted double-digit year-over-year growth for 4 consecutive months. New home sales have been up year-over-year in volume terms for 4 straight months after declining by 39% year-over-year during the first 2 months of the year. Industrial production is also fully recovered. Now, let me move on to the third topic, getting back to the headline for our talk today, which is US-China relations. In my view, the US government's current approach to China is misguided and almost certain to hurt rather than help the American economy. The approach is misguided in part because it fails to recognize that over the last 40 years, engagement between the two countries has led to progress. Most Chinese people have a healthier and more comfortable life, enjoy far greater personal freedom, and China has supported US efforts to limit the spread of nuclear weapons and resolve the dispute on the Korean Peninsula. On the trade side, while China has clearly not lived up to all of its WTO commitments, it's done enough to enable GM to sell more cars in China than in the US. And China is especially important to the US semiconductor industry. Profits from sales in China help finance continued R&D by China's tech companies. The structure of the Chinese economy has also changed for the better. When I first worked in China in 1984, there were no private companies. Everybody worked for the state. You couldn't even find a privately run restaurant. Today, almost 90% of urban employment in China is privately owned small entrepreneurial firms. More generally, we should recognize, I think, that it's just not possible to decouple from China's economy, which last year accounted for 40% of global economic growth, a larger share of global growth than from the US, Europe, and Japan combined. Moreover, it will be difficult to impossible for the US to address global issues like climate change, nuclear proliferation, and drug trafficking without cooperation from the Chinese government. So there are 2 specific mistakes being made in Washington right now that I think we should all worry about. First, there's an environment in the US which is increasingly unwelcoming to Chinese companies. The administration has stopped the retirement plan for federal workers from offering an option to invest in an index which includes Chinese stocks. The State Department has pressed university endowments to divest from China. Local governments have urged state pension plans to divest from China. And Congress is considering legislation that would require delisting of Chinese companies from New York exchanges if the Chinese government and the US Public Companies Accounting Oversight Board, PCAOB, can't reach agreement on audits of accounting firm workbooks. All of this is already discouraging Chinese companies from considering their US listings, which will be bad for our capital markets and bad for American investors. The second mistake is that there's an environment in the US which is increasingly unwelcoming to foreign students. The US State Department reports its issuance of student visas to Chinese applicants declined by 29% in its 2019 fiscal year. So that's pre-COVID compared to 2016. And it wasn't only Chinese students who decided to go elsewhere. Over the same period, F1 visas issued to Indian students fell by 30%. Total student visa issuances declined by 23%. This is important for many reasons, including that immigrants are important to the US economy. Academic studies have found that immigrants are disproportionately likely to hold STEM degrees, and immigrants start firms at higher rates than native-born Americans. Immigrants are also key to innovation. Immigrants in the United States are about 14% of the workforce, but account for 1/4 of US patents. Now, Beijing too is making mistakes, and Hong Kong is a great example. Becky is going to talk more about that, but in my view, the new national security law represents the end of one country, two systems, and is a serious loss of political freedom for the people of Hong Kong. Now, personally, I'm frustrated with the limitations of engagement on achieving the full range of US objectives with the Chinese government. But I also think we need to be clear about what's been accomplished and realistic about whether alternative policies by the US government would have achieved more in the past or less, and are more or less likely to succeed in the future. Finally, my last comments are on the impact today of these political tensions on China's economy and investment environment. So far, there's been little impact on the Chinese economy, and that's because China's economy is no longer export-oriented. Over the last 5 years, on average, net exports, that's the value of a country's exports minus their imports, net exports have contributed on average over the last 5 years, 0 to China's GDP growth. And also the US is no longer that big a market. Last year, only 17% of China's total exports went to the United States. So at my firm, at Matthews Asia, we focus on Chinese companies selling goods and services to Chinese consumers. And here you can see the political tensions have also had little impact. As of yesterday, our China Growth Fund was up 24% year to date. Our China Small Companies Fund was up 59%. Our A-Share Fund was up 46% year to date. And our Asian Innovators Fund, which is mostly China, was up 41% year to date. So I'll stop there and turn it over to Becky and look forward to the Q&A. Thanks.
Thank you very much. So from my perspective, I think we also start with an introduction of our institution. So Standard Chartered Bank is one of the 3 note printing banks in Hong Kong. The other 2 are HSBC and Bank of China, Hong Kong. And our function in Hong Kong has been, we are one of the leading retail bank, and as well as we are one of the key players in terms of trying to bridge the international investments into China, Chinese investment into the rest of the world, by not only investors, but also by the corporates. So from a Standard Chartered's perspective, we actually see a lot more opportunities in the coming few years as Hong Kong's role is likely to become even more important on the back of this China-US geopolitical risk. So if we just take a step back and look at what's quite likely to happen from a geopolitical point of view, we have no idea about the outcome, but the only thing that we know is that this is going to be a very lengthy process if what history is telling us would be repeated. For example, if we look at the US-Soviet Union, the Cold War, it lasted for nearly 50 years. And even if we count it from the start of US started to have goods embargo or even sanctions of key Russian institutions until the end or the collapse of the Soviet Union, it took almost 50 years. So one thing we are certain is that any conflict between China and the US is likely to be of long-term nature. There is no short-term solution, and things are more likely to evolve relatively slower than what people has been anticipating. But on the back of these backdrop, Hong Kong will actually start to play a much more important role, and its uniqueness, it's irreplaceable by any other Chinese mainland cities. So to be very clear, the Chinese incentive by either imposing the national security law here in Hong Kong or to impose tighter control on other issues on Hong Kong, the purpose is definitely not trying to make Hong Kong another mainland city, but instead trying to make things still under control. So what are these uniqueness is making Hong Kong so important to the mainland China? First of all, Hong Kong is China's most important foreign currency fundraising center. So we can talk about Shanghai, Shenzhen emerging into key financial centers globally, but none of these financial centers would give China the edge to raise foreign currency, either in equity IPOs or in bond issuance as well as in loans. Second, Hong Kong is the only place within the that is under control by China that is having a common law system. And this common law, this legal system is similar to all the important financial, all the key financial centers globally, such as London, New York, and Singapore. So by having this unique common law system, it means that there is no other place in mainland China or even Macau can be playing the function as Hong Kong. And Hong Kong, as of today, is remaining a very important conduit between the mainland and the world. We could say that this role has been evolving. For example, in the past, Hong Kong's major function is to do re-exporting business or being the conduit of trade business between the mainland and the rest of the world. But as of today, even after, for example, US removing some of the preferential treatment to Hong Kong, reducing some of the benefits in terms of Hong Kong and US bilateral trade, we haven't really seen much economic impact because Hong Kong's role in terms of facilitating trade-related activities is no longer very important to China. But it remains a very important conduit when it comes to cross-border financing activities as well as cross-border investment activities. For example, even just in last year, 2019, we still have over 60% of China's overall FDI coming through Hong Kong. And at the same time, the Bond Connect, the Stock Connect programs remain the very important channels for foreign investors to access China's onshore market. And this role is only expanding because of the uniqueness of the Hong Kong dollar. So in a sense is that Hong Kong dollar is China's US dollar. After the imposition of the Chinese the national security law, China has been having every incentive to cement Hong Kong's role as the international financial center because Hong Kong dollar is the most important cushion in case China-US tension escalates into the financial area. For example, we have started to see more Chinese companies, especially the companies that are being included to the unreliable entity list by the US government, started to convert their US dollar holding or borrowing into Hong Kong dollar. Under the current global environment, no company, including no Chinese company, will be able to conduct international business, including investment, trade, other business, without having exposure to the US dollar. But again, under the current environment, as it has become increasingly more risky for these companies to be directly holding US dollar because they could be facing sanction risks. As such, Hong Kong dollar is becoming the best proxy to enjoy the same currency exposure without the equal level of risk. And the Hong Kong dollar peg is very difficult to attack given Hong Kong's very sizable FX reserve positions. For example, for such a small place like such as Hong Kong, historically Hong Kong's FX reserve is ranking number 6 to number 8 globally, similar to the level of Saudi Arabia, higher than South Korea, for example. So it's making Hong Kong dollar a very difficult target to attack. And what's more important is that on the back of the support by the mainland companies, we have seen a big pipeline of all these IPOs coming to Hong Kong, which in a sense is telling people that if you would like to share the growth of these good quality Chinese companies, you first have to buy Hong Kong dollar and then buy their share. So as such, just to conclude from here, we are seeing greater opportunities as a bank in Hong Kong, and we also feel other financial institutions would have a greater role to play in Hong Kong as it evolves into a more important center connecting China and the rest of the world. Thank you.
Thank you all so much for that broad but succinct and helpful overview. Now we'll transition into Q&A. A reminder to everyone viewing this that if you have any questions for the panelists, please send them via the Q&A function on Zoom. I'll begin with one specifically for Andy, but both of you are, either of you are welcome to weigh in. You mentioned delisting efforts on the part of the US government. Do you think that Hong Kong will be the primary beneficiary of US government efforts, including the President's Working Group report, which includes recommendations to the SEC, and the Holding Foreign Companies Accountable Act that could result in the delisting of US listed Chinese companies? And if so, will these companies likely move to Hong Kong, or do you think they could list in other locations as well?
Okay, thanks, Allison. That's a great question. Yes, it will be a boon to Hong Kong, and I think will be a detriment to the U.S. capital markets. But let me give our listeners a minute of background, because not everybody might be familiar with why this delisting proposal is out there. It's all about a dispute over enforcement of a rule that came out of the Enron crisis as part of the Sarbanes-Oxley legislation, which requires a somewhat obscure U.S. government agency, the Public Company Accounting Oversight Board, the PCAOB, to audit the workbooks of accounting firms that audit companies that are listed in the United States, regardless of their country of origin. And the PCAOB has agreements with countries around the world. Sometimes it's been problematic, like with France and Belgium, but the most difficult issue they've had has been with the Chinese government. So it's not a problem with the Chinese companies, it's with the government, which has been reluctant to allow the PCAOB to audit the workbooks of the accounting firms auditing Chinese companies listing in the US. The issue's come to a head recently, and there's legislation before Congress which would force Chinese companies to delist if there's not an agreement between the two governments on how to do this. That legislation has a 3-year timeline, which kicks in once it's signed into law, which hasn't happened yet. So in a sense, that's not good because it's putting pressure on the Chinese government to solve this. And my personal view is if the Chinese government wants Chinese companies to list in the United States, they have to allow them to play by the same rules as everybody else. My problem is there a genuine effort going on in Washington right now to try and reach agreement with the Chinese government? The Chinese regulators have said repeatedly this year that they would like to find an agreement. They claim to have offered a solution to this problem, but are not getting any feedback from Washington on it. And my view is that, well, this failure to reach an agreement on a not that complicated issue would really be detrimental to our markets. We haven't yet seen this in a concrete way yet. The number of listings by Chinese firms in US markets this year is still strong, but we can also see that the trend is moving in the other direction. We can see some very well-known names have already decided to either list a secondary listing in Hong Kong or do their primary listing in Hong Kong. And talking to some of my friends in the private equity world in China, they tell me that companies that a year ago that would have been trying to list in New York are now looking only at Hong Kong. So that will also be to the detriment of American investors because the regulatory oversight in Hong Kong is not quite as strict as it is in the United States. Thanks.
That's incredibly helpful. John or Becky, did you have any thoughts on this question as well?
Just one comment. I mean, we're going to have probably one of the most high-profile deals in the next couple of months, which is Ant Financial, the subsidiary of Alibaba, a company that obviously could choose to list in New York, London, anywhere, multiple listings, and they are going to list in Hong Kong. So I think to reiterate what Andy said, I mean, that's exactly what the U.S. is missing out on. It's also exactly what some of the largest, most successful Chinese companies are focused on. So I think that's really a resounding demonstration of the environment that we're in. I would say just a comment on the political environment. I mean, we are in one of the most, or probably the most divisive elections ever in the U.S. So I don't see anybody trying to work with the Chinese anytime soon, at least until November 3rd. And then we might not even know the results of the election even into December. So it would be nice if this ended up being a lot of rhetoric, because I think there is a lot of rhetoric. Everybody wants to have the sound bites on negative China, beating up China, but that is one of the issues.
I think probably I just add from a currency and capital flows perspective, because I'm not an equity person. I think the most counterintuitive thing that happened to Hong Kong after the imposition of the national security law is that Hong Kong dollar has been actually strengthening. Both spot and even these days, if you look at 1 year forward, it's staying very, very close to the stronger side of the band. And on the back of that, there's actually capital inflows into Hong Kong due to those IPOs. So as we said earlier, people need to first buy Hong Kong dollar before they buy those shares. So if you look at how significant the capital inflows that has been into Hong Kong, that basically since May, the imposition of the new law, and now Hong Kong's aggregate balance indicating the level of excess liquidity liquidity in Hong Kong's banking system has risen by nearly 140%. And this is one of the fastest period of rise of Hong Kong's aggregate balance, and that basically indicate a period of fastest capital inflows into Hong Kong. So we believe that these would be very different from what people initially expected when everyone just saw the law. So that's why that also indicates like China's purpose on dealing with the Hong Kong issue might be slightly different from how it looks like at the very beginning.
Excellent points.
Just to comment on the capital account, because I think that's really important. Everybody knows that China has a closed capital account. They need, and we know longer term that China wants to open that up, but they can't do it overnight. If they did, they don't know what would happen. I don't think anybody knows what would happen. And so Hong Kong has to be that conduit, as Becky was saying, in terms of companies wanting to do business and also letting the pressure out of the internal in terms of capital flight and capital diversification as well. So I think that's really key to the long-term success and why Hong Kong will remain important.
Great, excellent points all around. Kind of transitioning into a bit of a different subject that we haven't quite touched on yet in this panel. How likely are US sanctions on Chinese banks, in your opinion, under the Hong Kong Autonomy Act? What form do you think they will take, and what would be the implications for both Hong Kong's role as a global financial hub and for financial entities currently operating in Hong Kong?
Okay, I'm happy to start for this question. So I think this is actually a very interesting scenario if the US has really started to target Hong Kong banks or Chinese banks on the back of this law, because the natural beneficiary for any of these actions most likely will turn out to be the CNY. Why is that? Because if we look at, like here in Hong Kong, when we look at all the major players, none of the biggest guys are Hong Kong local banks. So all the big players here in Hong Kong are either international bank or Chinese banks. So even when we look at US banks, all the big US banks have an interest in Hong Kong. And for some of the Chinese banks, they are, in a sense that they become a bit too big to fail. So if we recall what happened during the Lehman situation, that any of the so-called shareholding banks or tier 2 banks in China today are much larger than Lehman when it went under. So it's hard to imagine if there's anything so drastic to bring down one of these Chinese banks, not necessarily the big five or the second tier banks, that is going to create a huge consequence globally. And second, the easiest way to attack either Hong Kong's financial system or the Chinese bank's interest in Hong Kong would be the Hong Kong dollar peg. But attacking the Hong Kong dollar peg, it means it's restricting one of the world's largest reserve managers to be holding US dollar assets. And that definitely undermines the US dollar's reserve currency status. And the first currency to benefit definitely, again, will be the CNY. So that's why it has become a very strange situation that if you target the Hong Kong financial system, you're ending up hurting the dollar probably more than Hong Kong itself. And therefore, we feel that the more likely scenario is that it could, in recent years, it could be targeting, for example, selected smaller branches of Chinese banks, for example, restricting their access to the SWIFT system and so on. But at the same time, we also saw what China has been preparing. It's all to prepare for such a day. For example, China has been actively promoting the digital currency, has been using new technology for cross-border payments and conducting cross-border payments outside of the SWIFT system and implementing its own SIP system, CIPS, or China International Payment System. So all these are only just to prepare for such a hard decoupling with the US dollar.
Yeah, and maybe I'll add a couple of points to what Becky said. I agree. I think it's unlikely that the US government is going to sanction any major Chinese or Hong Kong banks. If we look at what the Trump administration has been doing and saying about sanctions on China, we can see that often they have made statements which turn out to be really difficult to implement and come under a lot of pushback from American industry. So we could see that on the WeChat ban, for example, There was a lot of pushback from US industry on how that might affect their use of WeChat in China. There was pushback on whether the broad language in the executive order might have an impact on American investors who own shares in and receive dividend payments from Tencent. And so what they tried to do, although that's been blocked now by a judge, was much less dramatic. Specifically in Hong Kong, several months ago, I spoke to a Trump administration official who said they were thinking about trying to block the Hong Kong government from managing the peg against the dollar. And when I pointed out to the Trump administration official that the Hong Kong government did not need the permission or cooperation of the US Treasury or the Fed in order to do this, he paused for a minute and said, really? So there's a lot of political rhetoric that's not being thought through very far in advance and then gets solved. But the last point I want to make, consistent with what Becky was saying, is just these conversations, just the fact that we're talking about these things is really bad for the US financial system. If the US government talks about politicizing SWIFT, that puts energy behind other countries trying to come up with a parallel system to avoid the possibility of US political sanctions down the road. If the US government talks about sanctions affecting business with the US dollar, that promotes other currencies as competitors for reserve currencies. So in effect, the US government is taking steps which over the long term have the potential of weakening the US's own financial system.
Just to reiterate, in the example of Russia, where we had sanctions and actually Europe had sanctions and they annexed part of another country multiple times, the U.S. government never went after Sberbank, which is publicly traded, government-owned, government-controlled. They went after smaller banks that had, very little consequences. So I think, if they were to do that, I think that would be probably the beginning of a very, very difficult relationship that would be a much greater conflict. We have sanctions, the US has sanctions in Iran that are of that magnitude. So basically are strangling the regime. So just as an example of current policies, I think as Andy mentioned and Becky, a lot of it is rhetoric. It is negative that we're talking about it, but I see low probability of that happening.
Sure. Moving to the national security law, Becky, I know you touched on, well, a couple of you touched on the potential impact of the national security law on Hong Kong's role as a global financial hub as well. I'm curious to hear the rest of your thoughts. Do you think the national security law will have any impact on Hong Kong's appeal to some foreign, particularly Western financial firms? And if there is any impact, will that be offset by the entrance of firms and general interest from mainland China?
I think the easiest explanation on that is that since the start of this year, despite all these, despite COVID, despite all these China-US conflicts, we see a record pace of foreign financial institutions getting into the mainland China. If people are not fearful about the mainland China, we can't imagine that there will be fear about doing business in Hong Kong, being such a great conduit and so much business opportunities to capture either mainland activities or capture mainland's future money to invest in the rest of the world. Just to name a number of examples of the opportunities that we are seeing ourselves. For example, China is already looking to expand the current northbound Bond Connect program to include more instruments. And at the same time, they might also introduce the southbound Bond Connect, which allowing Chinese money through Hong Kong's banking system to invest in the rest of the world. And at the same time, they've already announced this Wealth Connect program, which means the mainland individuals living in the Greater Bay Area will be able to directly buy those mutual funds, for example, from US asset managers, European asset managers that are available in Hong Kong's banking platform. You can imagine this is great opportunities for banks here. So far, we haven't seen really material negative implication on Hong Kong, although there are obviously some. But just to name a number of examples of so-called negative actions, you have sanction on certain individuals, which have minimal impact. The other ones are also relatively mild, for example, making visa applications in Hong Kong in line with the mainland. But in fact, as of today, both mainland passport or Hong Kong passport would be eligible for 10-year US visa. the only difference is that the application process is slightly different. And the other is just making it more troublesome for Hong Kong and US bilateral trade. So until now, all these conflicts or removal of preferential treatments has been avoiding the financial sector so far. And we feel probably the follow through would be relatively limited from here as well.
I agree with the points that Becky just made, and I am optimistic, but I think it's also worth pointing out some of the risks here. Because the national security law is quite new, we're not really sure how it's going to be implemented with respect to the financial services industry in Hong Kong. So I agree with Becky that I do not believe the Chinese government wishes to damage the financial sector in Hong Kong. I think it still wants it to thrive. But we need to be careful if they implement the law in the coming years in a way which has a chilling effect, even if it's unintentional, on the ability of people in the industry in Hong Kong to write critically about about mainland economic policy or Hong Kong economic policy, about state-owned enterprises that happen to be listed in Hong Kong. That would have a negative impact. If there is a breakdown in the rule of law as it applies to commercial and business cases, that too would have a negative consequence for Hong Kong's continued role as an Asian financial center. We're not there yet, and I'm optimistic, but those are risks that I think we need to be paying attention to.
I think, this move was inevitable in terms of China and Hong Kong, right? The question is, and it's all about control, and it's all about keeping the party and in power. And I think, we see that also with Macau, where there's new legislation there where the government's requiring people visiting Macau to disclose, their assets and where they're getting their assets. So more indication of like trying to control flows of money, and then also, the risks around that, but then the political consequences as well.
Excellent. Drilling down on the Hong Kong dollar, which we have already touched upon, Becky, you mentioned that the Hong Kong dollar recently has been strengthening and capital inflows have also been picking up, and that one of Hong Kong's core advantages as a financial center is arguably its stable currency, the dollar peg. Do you see any potential risk to the Hong Kong dollar in the future, either as a result of US actions or other external factors?
We feel the bar is very high for the Hong Kong dollar peg to break from here. It functions quite well. So basically, once it touched the strong side of the band, the HKMA would be passively injecting Hong Kong dollar to the extent that when you have enough Hong Kong dollar in the system, that Hong Kong dollar rates drops below the US dollar rates, and then actually your spot should be rising towards the weaker side of the band. So historically, this has been working very well. So the only the biggest risk for this to break is whether there would be an event that the Hong Kong Exchange Fund will no longer be able to hold US dollar denominated assets, because every single Hong Kong dollar is backed by the equal amount of US dollar assets in Hong Kong's exchange fund system. So as we discussed earlier, we feel the risk is relatively low at this stage, but even the Hong Kong dollar has been staying on the strong side of the band, it's almost also impossible for it to break lower as well, because again, under this scenario, Hong Kong government will just continue to accumulate US dollar as a part of the reserve and inject more Hong Kong dollar into the system. So at this stage, unless Hong Kong banks being stripped out of a US dollar payment system, a US dollar SWIFT system, or the exchange fund being unable to hold Hong Kong dollar assets, that we feel the risk for Hong Kong dollar peg to break is relatively low. It's different from a currency outlook perspective that over time, when we had a further inflows from here, we do see Hong Kong dollar moving away from the strong side of the band as well.
Great. John or Andy, did you want to weigh in on this question as well, or?
No, I think Becky's covered it well. This is not an issue that keeps me up awake at night.
That's good to hear. Great. So moving to a question from the audience on listing. With all the listing requirement changes being made to the Hong Kong exchange and even the STAR market, do you agree that overseas listed Chinese companies will continue to return home like we've seen since Alibaba completed its secondary listing in Hong Kong last year? And do you expect these listings to remain secondary, or might companies prefer to delist elsewhere for a variety of reasons, as a couple of you have touched upon? Do you think this trend is more due to push or pull factors from the US and China, respectively?
I think, as I mentioned before with Ant Financial, I mean, that's a perfect example. I think the other situation we're seeing is A-share companies basically coming to the H-share market. And it's also for what Becky talked about in terms of them wanting to grow outside of China, and then they want to have a subsidiary that actually can transact, as opposed to being solely onshore. And I think that's another driver that's going to increase listings or dual listings within the Hong Kong market. I think the dual listing with ADRs is interesting because those shares are fully fungible. So basically, and we're seeing institutions coming back and holding more of the Hong Kong. There's a cost to it, 5 cents, and you have to wait about 14 days or so. But these are not, completely dislocated listings. And I suspect over time, probably 80% of the trading with an ADR to H share is going to be 80% in trading in the US, 20% local Hong Kong right now. I suspect that shifts pretty massively over time. So that's another super positive for Hong Kong. Also has implications for Hong Kong dollar.
Thank you, Andy. Any thoughts?
I agree with John. I think this is primarily a push. As I said earlier, I think many Chinese companies feel unwelcome here, or less welcome than before. I also think that investors here are getting nervous about what might happen with a delisting or with political sanctions on holding the ADRs, that's the US shares effectively for Chinese companies. And as John noted, it's pretty easy to shift your holdings. In fact, it's a tax-free event. If you own an ADR in a Chinese company listed in New York that has a dual listing in Hong Kong, it's quite easy for an institutional investor to move those holdings from this market to the Hong Kong market. And frankly, in my view, none of these things are good for us here in the US.
I couldn't agree more. Taking another question from the audience, specifically directed toward Becky, you listed the reasons why Hong Kong is important to mainland China. What role, if any, do you see Hong Kong's corporate territorial tax regime, like offshore profits tax exemption, playing in maintaining Hong Kong's role as a key financial center?
I think in general, like Hong Kong's low tax environment, it's helpful, but it's not the biggest reason for Hong Kong to become a international financial center. For example, when we look at very simple, if we look at Hong Kong's banking system, including ourselves, constantly we had the problem that most of our liabilities are in Hong Kong dollar. For example, our salary are paid in Hong Kong dollar. But on the other hand, there are never enough assets in Hong Kong dollar because local companies do not want to borrow Hong Kong dollar because Hong Kong is such a mature and small market. There's nothing more to be invested here. And for international companies or Chinese companies, their borrowing from the Hong Kong banking system is always for overseas expansion rather than expanding here in Hong Kong. So that tells you a story that Hong Kong is never really a very attractive place from a corporate perspective. And indeed, for most of the financial institutions, for example, if you look at banks, most of these banks are based elsewhere. For example, Standard Chartered, our headquarters is in UK. The other note printing bank, HSBC, also a British bank, and then Bank of China, Hong Kong, a Chinese mainland bank. So none of these financial institutions are really based in Hong Kong due to the low tax environment. But the low tax environment is very helpful for Hong Kong to retain the financial expertise here in Hong Kong to facilitate the continued success of the financial system. So the key or the key to Hong Kong's success as an international financial center, it's still that it's the only place in China that is capital that has an open capital market. And with the mainland diverting all of these cross-border pilot programs, cross-border flows, cross-border investment program through Hong Kong, that Hong Kong would naturally continue to play a very important role. Because as of today, what we have just started to see is foreign money started to pour into China. For example, despite all these market volatilities, etc., we saw foreign investment in China bonds rising by more than 70%, 70% year to date. But this is just the initial stage. You can't imagine China's capital account as opening one-sided. It has to go out. And indeed, they recently already started to announce some further expansion of QD quota, allowing more outbound investment. But regardless of the direction, it's massive of these flows are coming through Hong Kong. So that's the primary reason, rather than tax, for Hong Kong to retain such a status.
Yeah, and also worth noting that later today, it's very likely that FTSE is going to include Chinese bonds in their global index, as Barclays has already done, and that's likely to lead to a further acceleration in inflows into China.
Yeah, I was going to note that, Andy. It's a good point. I mean, if you look at the world interest rate environment that we're in, with rates at 0 in the US, Europe, Japan, 3% 10-year in China looks pretty attractive. And it might not look attractive now because everybody's worried on the election and the political news and all that stuff. But when people start to really look at where are we going to get yield, and I mean, that's a significant yield pickup, in addition to the fact that it is now in indices and you know, more widely held. So big driver of capital flows.
Transitioning into a slightly different topic, we've spent a decent amount of time on this panel discussing US-China tensions and their impact on capital market trends. Do you think the current trend of Hong Kong becoming an increasingly important location for secondary or primary listings of Chinese tech companies in particular, as will become even more pronounced as US-China tech competition becomes more elevated and mainland China places a greater emphasis on developing self-reliance in key and core technologies?
Yeah, I think that's a process that's already underway as well. And it's similar to what I was describing before with the unintended negative consequences of putting, or at least talking about putting, sanctions on the financial system. We're seeing the same thing in tech. So if you look at what some of my colleagues on our investment team have been doing in, let's say, our China Small Companies Fund or our Asia Innovators Fund, we're increasingly finding innovative, entrepreneurial, privately run, publicly listed Chinese companies that are listed either in Shanghai or in Hong Kong, which are taking advantage of nervousness in the mainland of doing more business and being more dependent on American companies to create a market for themselves. And then you have to take a step back and ask the question, is it good or bad for American national security for China to be continue its dependence on American semiconductors? Or do we want to take political steps which will jumpstart China's own semiconductor industry?
Definitely. Becky or John, did you have any thoughts on this?
No, I think that what Andy just mentioned is already happening. I mean, we are pushing them, and unfortunately, because of this, you know, the bipartisan nature in Washington and the election, we're not focusing on things like rolling out 5G and autonomous vehicles and AI and everything else. And frankly, they're catching up very fast. Obviously, in the semiconductor business, if you look at, you know, locally compared to TSMC, they're years behind, but in other areas, they're probably ahead of us. In terms of adoption of technology, they're ahead of us, and that's going to drive innovation. So if you have, you know, capital markets that feed into that, that's not just the NASDAQ and it's local Hong Kong or even onshore, that will fund that growth. So yeah, I mean, I think, you know, we had that session I mentioned yesterday with Bob Gates, former Secretary of Defense. I mean, we need a longer term plan, and we need to, you know, really incentivize the investment from the US side. And frankly, I think if we do that, that ends up being a win-win, because you have, you know, China doing well in terms of local domestic growth, but then you have US doing well. And I think there is a scenario where that could potentially happen.
Yeah, and looking at the back end of, I'm sorry, go ahead, Becky. I was just going to say, looking at the back end of that, it's not only about Chinese companies, but if we're worried about the strength of the American tech industry, we have to think about where their revenues come from. I think last year, Intel probably got about a quarter of its global revenue from China. Qualcomm, I think about 2/3 of their global revenue last year came from China. If they lose those markets, how do they make enough money to continue investing in R&D to stay ahead of everybody else the way they have been?
Yes, I agree with both Andy and John. I just want to draw you to an interesting example of what happened over the last year. So when China-US tech war started, if you look at the trade between mainland China versus Korea and Taiwan, that you also find some interesting responses, and that could be applicable when the tech war is spreading out to a broader range of the market. For example, you started to see China's imports from Korea declining for some time because China is trying to replace some of the Korean productions by domestic productions. On the other hand, Taiwan's exports to the mainland is surging because Taiwan happened to make the best alternative of US restricted products. And therefore, this story tells you that China's choice is basically, there are two choices. Either try to make the stuff themselves when the external supplies are no longer available for whatever that they are ready to do so, or they just look for supplies elsewhere. So from the US perspective, first is that this would be pushing to a decoupling between China and US tech circle. And at this stage, frankly speaking, China is nowhere near where that's close to the US, but in the past, China was too comfortable, assuming everything would remain available. The best example here is the operating system. US operating system dominated every single areas globally, include, for example, Microsoft Windows, and then you got your iPhone, your Android system. And the Huawei incident is forcing China to develop its own operation system called the Harmony, which is likely to be launched fairly soon. So this is an example that when China have no choice, they have to develop their own system, and it might not be a very good thing. Even from the US perspective. So just to end here, we feel that like from a tax perspective, if we just relate Hong Kong's role in that, Hong Kong would just continue to be a financial center because single development would need the money and they need to be financed.
Excellent points. I want to be mindful of time constraints on this panel. I think we have 2 minutes left. So I think we might have time for one last quick question from the audience on Hong Kong's significance to mainland China. We have one that says, how might Hong Kong's role develop as the Greater Bay Area Initiative advances? Becky, I think you began to answer this question somewhat earlier, but any additional thoughts you might have would be helpful.
I think it's interesting to look at the timing. Ahead of the introduction of the national financial law, there has been a lot of concerns that Hong Kong's role to China is weakening, like China is abandoning Hong Kong, etc. But shortly before China planned to introduce this role, China actually issued a so-called 30 rules regarding the Greater Bay Area's financial development, which emphasized to highlight or cement Hong Kong's role as the most important financial center and the leading offshore RMB center as well. And therefore, we have seen subsequently a lot more pilot programs being already planned. And what's good about Hong Kong and the Greater Bay Area is that the areas are very close, and the banks are a lot easier to work out solutions to open up China's capital market step by step. And whenever something becomes successful, this would be rolled out to nationwide from China's perspective, and international-wise from Hong Kong to the rest of the world.
Thank you so much for that incredibly succinct answering of our final question. And I just want to thank you all again for providing such helpful insights on developments and opportunities in Hong Kong and mainland Chinese markets. You've given us a lot to think about. Have a great afternoon, and we hope to see you all at our last panel.
Thank you very much.